Most people think Bitcoin ETFs were just another way to buy crypto without the hassle of wallets and seed phrases. Wall Street finally opened the door, retail piled in, and now Bitcoin's just another ticker on your brokerage account. That's the surface story. That's what everyone saw happening in real time. But what actually changed wasn't access. It was the nature of demand itself. The ETFs didn't democratize Bitcoin. They weaponized it. They turned a volatile, speculative asset into a passive income black hole that absorbs supply without anyone even noticing. And the scariest part? Most Bitcoin holders have no idea they're being squeezed out by an invisible force they can't see, can't fight, and definitely didn't vote for. Let's start with what everyone got wrong about the approval. When the SEC greenlit spot Bitcoin ETFs in early 2024, the crypto world erupted. Finally, legitimacy. Finally, institutional adoption. Finally, the floodgates would open and pension funds and boomers with their IRAs would pump Bitcoin to the moon. The narrative was seductive and clean. Bitcoin was going mainstream. But that narrative missed the entire point. The ETFs didn't bring new believers into Bitcoin. They brought new mechanics. They brought passive capital, the kind that doesn't care about decentralization, doesn't care about self-sovereignty, and definitely doesn't care about Satoshi's vision. Passive capital just follows an index, a strategy, a rebalancing schedule. It buys because the algorithm says buy. It holds because the fund structure says hold, and it never, ever sells unless redemptions force it to. This is fundamentally different from every other type of Bitcoin buyer that existed before. Early adopters bought because they believed in the revolution. Traders bought because they wanted to flip it for profit. Institutions bought because they saw a hedge against inflation or a speculative bet on the future. But passive buyers? They buy because Bitcoin is now part of their portfolio allocation model. It's a line item. It's a percentage. And here's the kicker. That percentage doesn't shrink when Bitcoin crashes. It rebalances. When Bitcoin drops and becomes a smaller part of the portfolio, the algorithm buys more to bring it back to target weight. When Bitcoin moons and becomes too large a part of the portfolio, the algorithm sells to rebalance. This isn't investment. It's automated gravity, and it warps the entire market. Think about what this means for supply dynamics. Bitcoin has a fixed supply, 21 million coins, and a huge chunk of those are already lost or held by diamond-handed whales who won't sell for anything. So the liquid supply, the actual coins available for trading, is way smaller than people think. Now inject billions of dollars of passive, never-selling ETF capital into that market. Every week, these funds are buying Bitcoin to meet inflows. Pension funds diversifying into crypto, financial advisors checking a box, millennials auto-investing their 401ks into a portfolio that happens to include a Bitcoin allocation. None of these people are making active decisions about Bitcoin. They're not watching the charts. They're not reading the white paper. They're just letting their money flow into a fund that buys Bitcoin on their behalf and locks it away in cold storage. And that Bitcoin? It doesn't come back to market. It sits there, silently, absorbing supply like a black hole absorbs light. Now here's where it gets controversial. The entire premise of Bitcoin was that it would free people from centralized financial control. No banks, no intermediaries. Be your own bank. But the ETFs are the ultimate intermediary. You don't own the Bitcoin. The ETF does. You own a share of the ETF, which is a claim on the Bitcoin the fund holds, but you can't withdraw it. You can't spend it. You can't move it to your own wallet. You're back in the traditional financial system, holding a paper promise instead of the actual asset. And worse, you're contributing to a system where a handful of massive funds, BlackRock, Fidelity, a few others, are accumulating enormous piles of Bitcoin that they control. They decide the custody. They decide the voting power if Bitcoin ever forks. They decide what happens in a crisis. This isn't decentralization. This is re-centralization with extra steps. But let's go deeper into the mechanics, because this is where most people's understanding falls apart. When you buy shares of a Bitcoin ETF, the fund has to go out and buy actual Bitcoin to back those shares. That's how spot ETFs work. They hold the underlying asset. So when billions of dollars flow into these ETFs, fund managers are hitting the market with buy orders. Massive, relentless, price-insensitive buy orders. They're not trying to time the dip. They're not waiting for a pullback. They're buying because they have to, because the structure of the fund demands it. And because this capital is passive, it doesn't react to news. It doesn't panic sell when Bitcoin drops 10% in a day. It doesn't FOMO buy when Bitcoin pumps. It just keeps buying, week after week, as long as money keeps flowing in. This creates a kind of silent, grinding buy pressure that's completely divorced from market sentiment. It's like a glacier, slow, inevitable, and it reshapes everything in its path. And here's the part that should terrify anyone who actually holds Bitcoin outside of an ETF. The more Bitcoin gets locked into these funds, the less liquid the market becomes. Liquidity is what allows prices to move smoothly. It's what lets you buy or sell without crashing the price. But if a huge percentage of Bitcoin's supply is sitting in cold storage wallets controlled by BlackRock and Fidelity, never moving, never trading, then the liquid supply shrinks. And when liquid supply shrinks, volatility explodes. A smaller pool of available Bitcoin means that any large buy or sell order has a bigger impact on price. So, ironically, the thing that was supposed to make Bitcoin more stable and accessible, the ETFs, might actually make the market more violent and unpredictable for everyone who isn't in an ETF. The retail trader trying to time the market? They're now trading in a pool that's being drained by passive capital. The long-term holder hoping to sell one day? They're competing for liquidity with behemoth funds that don't need to sell, ever. Now let's talk about what this means for Bitcoin's price discovery. Price discovery is supposed to be a democratic process. Buyers and sellers come together, they negotiate, and the market finds a price that reflects supply and demand. But when a massive chunk of demand is passive and price insensitive, price discovery breaks. The ETFs don't care if Bitcoin is overvalued or undervalued. They don't care if the fundamentals have changed. They don't even care if there's a better crypto out there. They buy Bitcoin because their mandate is to track Bitcoin. Period. So you end up with a market where a huge portion of the buy side is just blindly absorbing supply, regardless of price. That's not price discovery. That's price distortion. And it means that Bitcoin's price might not reflect its actual value or utility anymore. It might just reflect how much passive capital is flowing into ETFs, which is a terrifying thought if you're trying to use price as a signal for anything. And here's the really wild part that almost nobody is talking about. If Bitcoin's price starts to be driven primarily by ETF inflows rather than organic demand, then Bitcoin becomes vulnerable to the same forces that control traditional markets. What happens when there's a recession and people pull money out of their retirement accounts? ETF redemptions. What happens when financial advisors decide crypto allocation was a mistake and rebalance portfolios away from Bitcoin? ETF outflows. What happens when regulators decide to crack down on crypto and make it harder for funds to operate? ETF liquidations. Suddenly, Bitcoin's price isn't determined by its adoption as a currency or its utility as a store of value. It's determined by the whims of traditional finance, by the same boom and bust cycles, the same regulatory capture, the same institutional decision-making that Bitcoin was supposed to escape. The ETFs didn't free Bitcoin. They chained it to the legacy system. But let's be fair for a second. The ETFs did accomplish something. They made Bitcoin accessible to a class of investors who would never have touched it otherwise. Your parents can now get Bitcoin exposure in their IRA. Pension funds can diversify into crypto without hiring a team of security experts. Financial advisors can recommend Bitcoin without telling their clients to set up a Coinbase account. That's real adoption. That's real capital. And that capital is pushing Bitcoin's price higher, creating wealth for everyone who holds it, ETF or not. So there's an argument that the ETFs are a net positive. They're bringing in the money that will take Bitcoin to 6 figures, to 7 figures, to whatever moon we're aiming for. But that argument ignores the cost. The cost is that Bitcoin is being absorbed into the very system it was designed to replace. The cost is that the coins are being locked away from the people who believed in the revolution and handed to the institutions who only believe in profit. The cost is that we're trading decentralization for liquidity and sovereignty for convenience. So what does this mean for you? If you're holding Bitcoin outside of an ETF, you're now in a different game than you were a few years ago. You're competing with an invisible, relentless, automated buying force that never sleeps and never sells. If you're thinking about buying Bitcoin, you need to understand that the price you're seeing might not reflect organic demand anymore. It might reflect ETF inflows, which could reverse at any moment if the macro environment changes. And if you're one of the people who bought Bitcoin because you believe in financial freedom and decentralization, you need to reckon with the fact that the ETFs are undermining that vision, even as they pump the price. This is the paradox of Bitcoin in 2024 and beyond. The thing that's making it more valuable is also making it less free. The institutions that are adopting it are also capturing it, and the silent, passive absorption of supply by ETFs is reshaping the market in ways that most people can't see and won't understand until it's too late. Bitcoin ETFs changed the game, but the game they changed wasn't about price or adoption. It was about control. And the question you need to ask yourself is, who's really winning?